Trader psychology, money versus process. So as you approach the markets each day, what's on your mind? There are a lot of influences out there. There are TV hosts who look at the markets, have their own opinions, say a lot of things. Fund managers and analysts come on these shows and they've got big ideas. There are chat rooms, people on there talking about trading ideas, and Twitter and stock twits and countless other places where people are talking about trading ideas, the big profits that they've made, and big successes that they share. People not often willing to share all that much about the challenges that they've had. And often we start to think, if I can only make this much based on what they're doing, if these trades can really work, boy, I can maybe build up my account or pay some bills or, pay those college debts off, make up those losses that are staring me in the face every day when I wake up and come in and look at the computer as my account is lower. Maybe I won't have to tell my spouse about the money I've lost, or my partner, or anybody else. All of these things really come into my mind. The theme I often bring when I work with traders and talk about things about trading psychology is that you have to really be trading for the right reason. This piece we're going to do now actually could have been in the trading strategy and plan section, but there's so much tie in here to trader psychology that I decided to put it in there. When we are trading for some of these other reasons, to solve some problem in our life or to solve the issues of not feeling good about our trading, that is a recipe for trouble very, very often. So what we do is we tie our expectations of our trading profits to what are these often unrealistic expectations of, things that we want this success to solve in our life, or just some level of return that we think that we can get as traders. Think about this. What are the returns when you have money in the bank? The real world out there only sees that 0 to 1% interest rates, but as traders we start to think about bigger money. 2 to 3% in the real world a month is just unheard of. It's unbelievable. Of course, most traders, when they look at what their potential returns are, think about much bigger returns than that. And what happens is that, it sets it sets us up for failure, is what it does, because it's often hard to achieve those higher returns, and it's often hard to achieve the ability to solve these life issues that we often ask trading to do through that level of success. So what that does is, when we have that focus, it puts our focus on the money versus the process. And that's what this is about: focus on money versus focus on process. And when I say process, you might put that, you might change process for our plan, for our guidelines, whatever it is that we focus on. It's, how we engage in the market versus the money aspect of it. And another big portion of this is, when you focus on money and you focus on what the money can do, there is big risk of emotion coming up, and we want to really avoid that. All the emotion, driving our decision making. So what I want to talk about now are, the pitfalls of a big focus on money versus focus on process, and then we'll talk about process in a little bit and how to get into a healthier place. So first slide I'm going to share with you is about the pitfalls of focusing on money, or when money is our motivator. So here it is, the pitfalls of when money is the driver over process. Well, what we often do is overtrade, have to make the money back, I can't stand this losing trade. We get into this thrashing, coming in and out of the market quickly, often taking excessive risk when we overtrade. Size much bigger than we want to be trading, potential losses much bigger. Next one is under trading. And we think to ourselves, if I lose more money then, and all of these negatives, all the negative dialogue starts to come in. And so because we don't want to feel that, we often create distractions. That again will bring us to under trading. There is often a numbing that people do as they get into addictive behavior, and they get into some over analysis. Where they just keep relooking and relooking and end up not really trading. Another pitfall is that we often let our losses run. Thoughts go in our mind. If I cover this loss, then it's often I can't get the money back, right? I'll never make it back. I have to tell blank. Who is it that I'm going to have to tell about more money that I lost? And I will feel. This is where emotion really comes into it. We let the loss run. And if I take the loss now, I can't get it back. So I'm going to keep feeling this negative emotion, sadness, shame, fear, anger, whatever it is. I'll never make it back. And we get into this place where we just sit and we freeze and just look at the losses as they mount on a trade. Another pitfall is taking profits too fast. I need this winner because if it reverses, then I won't be in there. And I'll lose too much money if it reverses. And holy cow, if I had a winner and let it reverse to a loser, then I'm bad. I learned that you should never let that happen. So, every time, there's a little wiggle in the market noise takes us out. There's so much emotion in the trade about getting that winner locked in that we end up with, letting our losses run, having big losses, and then taking profits too fast and having, very small gains. And we get this win-loss ratio that can never, ever bring us long-term profits. And the last one, a pitfall, is a lot of justification. And we think about, what this person said. They said it was going to go up, and I like the trade, so what I thought was. I thought it was going to go further on the upside, and boy, it stopped there, so I kind of waited, and I looked over here, this chart said this, or this analyst said this, or how about this one where the market keeps going in one direction, and you keep saying, well, I didn't think the market could, and justification just kind of holds us in those positions, so that is often a big issue. So those are the pitfalls of when money is the driver over a process. So let's talk about the alternative. What is the alternative? The cliche really is, it's about the journey. And how many times have you heard that, right? I think that was way back in the 60s or 70s we started that. We all know that there is a big importance to our plan, to designing the plan and staying on it. It's about the rules, right? The amount of risk we're going to take, the size of our trades, the amount of money in each trade, and overall the approach. So it really is about the journey and knowing that this is a process as a trader. I'm a trader 41 years, and I'm still in the process. Because the markets change, the way we approach the markets change, the players in the market change. There's so much that's changing all the time, and it's often 5 steps forward and 4 steps back, or even 6 steps back, and then a few more steps forward, and then all of a sudden blows up and a couple steps back, and we hope that in a month's time we've taken enough steps forward for it to make sense that we can make a profit. Remember that old game Chutes and Ladders, where you would move forward and all of a sudden you'd say go 5 steps back or go back to the start. How many times have we gone back to square one? I always say square one, or to the beginning of the game and starting over again. And that's really what trading is often. And I think that some acceptance of that bumpy road that trading is goes a long way in keeping us on process, on the journey, and knowing that's really what the journey looks like. So I want to take you to slide 2, which I call the 10 guideposts for being on this journey, or the 10 guideposts for trading with a focus on process. So I'm going to bring in that slide right now, and I think there's a lot in here that is going to be helpful. The 10 guideposts for trading with focus on process. Number one, the only money consideration really is use of capital, right? You don't really think about the money other than, what is, your own plan say to you that you want to put in play on any trade, or what you're going to put in play as far as the size goes, as far as your rules. But that's really the only way you're going to consider the amount the money is by the amount of capital. And you're going to avoid that P&L focus. A lot of people are day traders, and all they do is spend a lot of time watching that bouncing ball of that P&L going up and down. And that is unbelievably distracting and not in line with being on process. Number two is, focus on your risk reward and your allocation of capital. That means that, if you are going to put on trades that have X amount of dollar risk, what is the appropriate reward for you, and what is it that you look at in the markets that allows you to apply a certain risk reward? How do you know what the risk reward is? So it's spending a lot of focus on learning how to manage that risk and manage that reward through proper allocation of capital on each trade and through your analytical process. So it's strategic process and analytical process all put together can keep you on your focus of risk reward. Number three is have reasonable expectations of return and acceptable losses. As long as you know that you have reasonable expectations, your expectations are not going to be based on what you want the money to do for you. And when you have when you know that losses are acceptable, that you're just going to take the losses when you have them, because your guidelines say that you should. You celebrate the loss. You're happy that you took the loss the right way, because you know that if you stay on this plan, that you're going to have bigger wins than losses, and you're going to have more wins than losses. And as long as you get into the place of focusing on that aspect of process, then you won't be apt to turn your focus to what you want it to do for you externally, and much more in line with your plan. Start your risk management pre-trade. So essentially, you're going to be, you look at a trade, you get an idea, and have in your mind, okay, what is the favorable entry? What is the exit for me in here? When am I wrong? And then, when is it time to get out, or when is it even time to add to the trade? So it's, you're going to have all of these ideas in advance. It's a lot less winging it because money is pushing your decisions. It's a lot more about an intellectual process. And that's especially true for strategic option traders, because basically all of your risk management is done before the trade if you're a pure strategic option trader. So hold to your trade size guidelines and capital use. Man, is that ever important? I mean, if you let's say you want to put 50% of your capital use, and you want to put 2% of your capital in any trade, or maybe 3%, then you know the size you're going to trade, you know what your risk is going to be, and you really stick to that. Number 6 is have a vision of your trade objective. So it's when you get into the trade, what is your expectation in there? Where do you think it's going to move to? Where do you think that the information will be that will take you out of the trade? So you're going to have a whole vision in advance. And I always found that incredibly important, because if you have that vision, then you can keep focus on a target. And that will keep you from getting so hooked up in the noise of the market, when you can really focus on your target through your analysis. And it's also not only that, but focusing on your holding on to that original analysis all the time and to your strategic approach. So if you were an options trader and you said, my objective is, often people try to make, 50% of their, if they sell a vertical spread, 50% of the credit they've taken in, then, if your analysis still holds up, then, you stick to your strategy and you don't make an early exit. Because you have a vision. Vision is so important in this discussion. It's number 7 is a favorable entry is such a high priority because, a lot of what gets us into this negative thinking about, oh boy, I got to make money to do this or do this, is that we have these triggers that can come that are emotionally based because of what we are not or what not doing. Those triggers are much more easily triggered when we get into a trade poorly. So that's why a favorable entry is so much of a high priority, and that's why I spend so much time on my charts. And a lot of people to get my charts, we have on our focus list of things that we trade support and resistance areas because we want to really make our entries in these high quality entries. So favorable entry, a really high priority to avoid the emotional triggers. Take ownership of your trades. If I say something, if other people on other networks say something, or if it's on Twitter or the trading rooms or whatever it is, wherever the cue comes from, make it your trade. If you can't figure out the analysis, if you can't figure out the risk rewards, if you can't do all of those and put it into your own guidelines, forget about it, really. Don't make the trade because it's got to be yours. Nobody's going to tell you how to get out of it. Nobody's going to take you out of it. So you really have to have a good sense for the trade. This is such a big one. Measure your success by percent that you are on the plan. So in other words, it's your quality of the engagement. So it's not how much money you made. The money will come when you really are on the plan really well. So it's I was 80% on my plan today. I was 50% on my plan today. Keep that in your journals. Make notes on that so you can improve on it and know how you got off. This really will keep you on focus on process when you do that. And number 10 is trade for stones. Now, I'm going to tell you more about this one. Or some reward other than money. And remember Slim's story. So it was back when I was on the trading floor and I was trading down there about 6 months. This would have been towards the end of 1974. I had a real good friend who was my partner in the menswear business, and we had 5 stores, pants stores, tie stores, from the point when I was 20 until 24 when I came to the CBOE floor. And we were like really best friends and talked about the markets all of the time. And at that point, I had been struggling and trying to figure out how to make money. And this is really what, believe it or not, way back 41 years ago, really cued me into this, whole concept of process versus money. And the process that we are talking about here when I mention stones, trade for stones, or something else, some other reward, is that for me it was always that focus on the money when I was first starting. And I didn't have a lot of money in my account, and it was important that I made money, and I had struggled a couple times, and even my parents who loaned me the money to become a trader there had made some comments about, is this right? Maybe I should sell my seat, those kind of things. And so there was some of this background pressure on me, and I was having this discussion with my partner, and we started to talk about, what if we just did what we were supposed to do? Don't worry about the money. And every time we did something right, somebody paid us a stone, just a little stone or a pebble. And then all of the times that we did things right, and really followed what we were trying to do in the markets in a healthy way, we kept getting these stones. And then at the end of the month, after we did that, we got to trade in our stones then for money. So it was never a thought about anything other than just doing it right and getting a stone, doing it right and getting a stone. So for a long time I just carried a little bag of pebbles with me to remind me as kind of an anchor about the importance of having some reward for following the plan, doing it right, and not worrying about the money, knowing that if you do that, the money will come, and completely take focus off the money and onto process. So that was my story about the stones. And so those are the 10 guideposts. And I think there's a ton of value in there, and I'd love to hear from you if you do look at this and you find it helpful. I'm going to give you an assignment. And that is just for you to do, and this is your mission if you choose to accept it. And that is to do a little process here, to pull out a piece of paper, and I want you to write down like 3 different categories of things. Number 1 is, what are the signs for you that you're influenced by money versus process? And just write those down. And so you have something to focus on about, how it is that you might get into those traps. Number 2 is, write down, and this could be kind of long, but I kind of want you to do it short. What is your personal roadmap on this journey, this chutes and ladders game that we're talking about, as to, what are your realistic rules? What are your realistic expectations? And your vision that you have on this journey, where you are right now and where you're going, and how you're going to, get there in some healthy way. So that comes to number 3, which is your commitments. What are the commitments that you're going to make in regard to this journey that you're on, and kind of changing the way that you're doing things from before, when you might have had a bigger focus on money, to what you want to do right now, so that you are a lot more focused on process. Then what I want you to do is I want you to write those things down, and I want you to share it with somebody, so that you have some accountability on that, and somebody can check with you on that. Could be your trading buddy, or your spouse, your partner, or your confidant, whoever it might be that you feel good about sharing this with in this process. And then you can check back in with them, or they can check with you if you ask them to do that, and know that you are on this healthy process of thinking about your process versus money. That is trader psychology for today, and I'm always real always real hopeful that it was helpful. And let me know. That's it, and I will see you in the next segment.